The banks aren't going to make money, but the mining companies are going to make money. And
so many old guys are trapped we've been in this raging bull market in bonds, and that may change if the yield curves change again and interest rates go up. The contention has been between bondholders and gold holders.
When interest rates go down, the price of the bonds goes up. And when interest rates go up, the price of the bond goes down. Today, it's only negative, not even negative 1%. So real rates are quite high. Nominal rates are low, real rates are high, but real rates are the ones that count. So where can rates go from here? I don't see the Fed going to a negative interest rate. So a negative target on Fed funds rates.
If I put money in a bank, I get less money back over time.
It happens through secondary market trading. What if I come along as a secondary market buyer and I pay you a premium for that bond? I pay you over par, so it's par is 100, I pay you 105 or 110 or whatever it may be. The minute the premium is higher than the strip of interest coming in, my yield to maturity is negative. I'm not going to get my money back, meaning I can get all my principal back, all the interest, and all that money together is not going to be more than I paid for that bond. Bonds can produce a negative yield to maturity through secondary market trading, even if the Fed sticks to zero. Well, the answer is it's not constant. It varies depending on the level of interest rates, something called the DV01, the dollar value of one basis. Well, what about gold versus bonds? What's up there? I would say have both.
But the reason everybody says you don't buy gold is because it had no yield.
We are in a depression. A lot of people don't know what a depression is because they assume it must be a continuous declining GDP. It's not. Two quarters of GDP, of declining GDP, is the technical definition of a recession. But a depression means depressed growth. You can have growth in a depression. It's just the growth is below potential. So if your potential is 3.5%, and your actual growth is 1.75%, that gap between, say, 3.5 and 1.75, that gap is depressed growth. Now, if your debt is going up 5, 6, 7, 8% a year, which it is, and if your growth is 1.5, 2% a year, which it is, which it will be in my forecast, then your debt to GDP ratio, when your debt's going up faster than your income, you're going broke. It's as simple as that. The pandemic, the social unrest, and the depression that all converged in 2020, we're not going to be out of this in 30 weeks or 30 months. It's going to take 30 years to get out of it. A lot of people don't know. You can make money in depression, you just have to see it coming. So anyway, we're in for deflation, not inflation. We may get to inflation. We'll probably end up there. I agree it'll end up there. We're actually living through a deflationary episode right now. And everyone's like, oh, look at all the Fed money printing. They printed $3 trillion in the last 6 months. So that's going to cause inflation. No. Money supply has nothing to do with inflation. Inflation is caused by velocity, which is the turnover of money. So let's just say you took the money supply from $4 trillion to $7 trillion, which is what the Fed did. In other words, if you don't have velocity, you don't have an economy. The thing that drives inflation is not the money supply, it's the turnover of money. That's the velocity. That's the zero in my case. Velocity has been dropping since 1998. It didn't start in 2008. It didn't start in 2020. It's been dropping like a stone since 1998. Now, that's the point. It's not how much money you print. It's whether people are lending and spending, and they're not. And it's psychological, and the Fed cannot control the psychology. And you've got to change the psychology, get out of that deflationary problem, which, by the way, the only guy who did it successfully was Franklin Delano Roosevelt in 1933. And how did he do it? He raised the price of gold.
Buy gold or silver. When you talk about spending, think about the people who lost their jobs.
Yeah, right.
They got nothing to spend now because the 60 days or 90 days of money they gave them, because the Democrats hate Trump so much, they're holding up the new, as Jim was, it's not a stimulus,
right.
It's a handout.
Right. But
now people today foreclosures are going to jump. All those airline pilots, 39,000 airline pilots lost their jobs, plus flight attendants, plus ground crew, plus airports, plus all the shops in the airports, plus the hotels. That's not stopping spending.
No, and look at that.
There's nothing to spend.
Right. All the sporting events that have closed. I mean, that's major dollars. Professional sports, college sports, bringing all that money into the college towns, bringing all that advertising dollars. The whole world economy is just shut down.
So it's really a tragedy, but that's what I was getting at with, Jim. $15,000 goal makes Kim and I rich. But unfortunately, what it means to me is a lot of people also getting very poor. And that's the real tragedy. And in Jim's book, The Road to Ruin, he talked about the rioting and they had to have armored trucks and all this. This is years ago. And now you look at all the rioting going on. It's just there's been so much chaos, which makes gold even more valuable. That's the good news.
We'll get to that 15,000 a lot quicker than 2025.
Maybe.
And I still say silver is the best investment because everybody can afford $20. That's how much a silver eagle costs.